Okay, Michael, anybody else hear me? Just Michael. Wow. I guess so, yeah. I guess they are away. Okay, we're gonna start the meeting. There you go. So, any questions before we get started? I'm gonna jump into this deal with Rodrigo. Sent me a deal that he's working on. Small group today, so maybe it'll be a shorter meeting. This will be the last meeting of this year. December will be off. We will come back on the uh, second Wednesday of the new year, which will be the 8th. Okay, so 8th, we'll be back the 8th. Okay, so mark that in your calendar. If you're connected to anybody, let them know if they didn't make it tonight. Um, so I guess no questions right now. That's okay if you don't. I'm going to jump into this deal with Rodrigo. Sam, so if we're looking for $100 per door for thumbs up. Yep. Are you asking that? Is that what you're saying, Nicola? I'm assuming that this is the best look at a lower price. I mean, the higher you get, yeah, it's going to be a problem to produce cash flow because, as a rule, I could show you, I think I shared this with you. There's a pattern. As you start getting into higher prices, the mid-range, what you'll see is about 50%, sorry, 0.5% of the purchase price per month is what you're going to see in the market. Does that make sense to everybody? That's about where it is. So that would be on a $300,000 house, that'd be $1,500 a month. Does that make sense? On a $400,000 house, that'd be like 2 grand. 600,000 be like 3 grand. But when you start getting into even the 6, 7, 8, $9 million, it starts getting tougher to even get half of that, per month. So obviously, as you go down on lower prices, you're going to see convergence between the rents and the purchase price. As the higher you go up, the hotter the market, the less likely there'll be any cash flow at all. Does that answer your question? It's a pattern you'll see in the market. You'll see it. It's about 50.5% per month is what you'll see. Okay, no worries. If you have more, if you want to expand on the question, it's cool. Yeah, I see. I see. Okay. Are we supposed to get 1%? Well, you're looking for 1%, Devin, but that's not always going to be there, right? If you can see 1% on a property, you pretty much know it's going to make money. It's something that you definitely want to look at. If you're looking at 0.5% per month, it's going to be a lot harder to make it work because of the cost of ownership, right? The expense of ownership, the financing, it will probably produce a negative yield, negative cash flow. So you're really looking for, obviously a 1% would be great. Obviously a cap rate of 10 would be great. A GRM of 6 would be great. But it doesn't mean the deal's dead. But there are points when you start getting into double-digit GRMs and cap rates of under 6, it becomes difficult to make it work. So obviously the 1% rule is kind of like a generalization, because at the end of the day, Devin, we don't know what it's going to cost us to finance the project, right? What is it going to cost us? Maybe the expenses are high. We don't know. But at 1%, you're likely to produce cap rate close to 10 and a workable opportunity to profit. I have a very good friend in Windsor, Sam. My idea is to focus in the market for multifamily. What do you think? I think Windsor's an excellent market. I think that's a great place to look. Great place to look, for sure. Very, very good market. Okay. Any other questions before I jump into this deal? Okay, let me share my screen. So we have a property here, and you can see that right away we're seeing that the monthly gross rent is $1,500. The purchase price plus repairs, but just looking at purchase price is $430. So right away, this ratio is going to make it very, very difficult to profit from. Okay, we know that because it's less than 0.5%. Okay, but let's continue with it. Okay, gross revenue is 18,000. Vacancy maintenance and property management looks like it's just shy under. So 3% for maintenance. Is this because it was recently rehabbed or fixed? Is that why, Rodrigo? Okay, all right. So okay, so when we put these numbers together, we're left with about 11,000. We are left with $11,427. Gross rent multiplier is 24, which is really, really high. Difficult to profit in a cash flow setting. Cap rate is 2.6. When we start adding financing to it, the standard financing 80-20, we get a 30-year at 3%, totally realistic. That's the rent, that's the mortgage payment, 1447. We see that we're running a negative cash flow. Okay. So far, Rodrigo, this is what you sent me, right? This is the deal. Okay, so I'm just looking at this. This is a couple that's divorcing. Let's see, 1,500 a month. Utilities, according to them, are 300. According to one of the owners, they're getting a total of 300 cash flow per month with a 40-year mortgage. They're asking 500K for the apartment, including the current tenant. Is that this property, or this is a second property that you're comparing it to? That's the second property, right, that you're comparing it to, Rodrigo? Can you hear? Okay. Sorry, the sound cut out for a sec there. Okay, so I'm asking, is this is so they want 500,000 for this property, correct? Okay, and they're telling you they're making 300 a month. Yeah. So a couple of things they said though. They got a 40-year mortgage. Okay. So let's go over here. Let's change this to 40. Okay. 40-year mortgage. Um, also, so 40-year mortgage is going to make a difference. It is going to make a difference. Okay. But you can see that they're still losing $300 a month. And you know, if we take away things like vacancy, maintenance, and property management. So if we make these all zeros, okay, and we bring this back over here, we'll look and we'll see that um, still, apparently still losing $5 a month, okay. So let's see what else we can do to make this work for them. I would assume that their mortgage maybe is 70-30. Let's see if that'll fix it for them. So it's more like 60-40. There you go. There's the $300 a month. So they're not counting vacancy, maintenance, and property management. Also, they have equity in the property is the assumption. It's because they probably didn't buy it. They didn't buy it for. Let's see. You said that they bought it, purchased 10 years ago for 200, right? So you know, they probably have almost no mortgage on it. I would assume very little mortgage. If they're making 300 a month, the financing alone has to be reduced, right? So they're probably only financing a small portion. Do you know how much they're financing? Do you know how much is the mortgage is left? $120K. So if we look here, 120K is left. Oh wow. 40, 30, 120. Okay, so yeah, they're gonna make money because there is no mortgage. The one thing though, because it's a condo, right? So the maintenance or the condo fees. Let's see, that sounds about right. So there's condo fees, right? So they're probably running at least. Do you know what the condo fees are per month? 650. Well, there you go. So 650. 5, about 3.6, I guess. 6. There we go. So 350 for that. We'll call that maintenance. It's really not maintenance, but it would reduce your maintenance costs, right? Because somebody else is taking care of the exterior of the property. So here, oh, there must be another expense that they're adding to it. Can't be vacancy. Can't be management. They wouldn't have put that in. Technically, they should be making more money, I would assume. Yeah, I would assume that they're making more money than 300, just because they have very little in the way of taxes you have, right? You have taxes right here, insurance. So you're telling me the property taxes on a $500,000 property are 2,500 per year? Yeah, that's pretty low. That means this property is way, and you can tell it's way overvalued in my view. It's had a great um, 10 years. If I were them and I bought it for 200, it was worth 500, I'd sell too. I'd sell. But selling to for an income property, no way. Selling for profit, they'll make 300 grand. You know, 300 grand is amazing, you know, in 10 years. That's way higher than the average. And if you want, just to give you an example, folks, if you look at this, I'm just doing this as a to show you the impact. 200,000. If I go down here, I can show you. So this is 5 years. Let's see if I can do this. Hold on one sec. A sec. Give me 1 second, folks. Okay, well, we're going to make these one equals this. Okay. So actually here, let's make that a 0. Okay. For the sake of math, just okay. So to give you an example, let's see what this does. Oh wow. So you can see that. Wow. I'm just trying to give you an idea of how much this has grown. Yeah. So the average appreciation of this property in the last 10 years has been, and we can actually add this. We can add this because that'll be a 10-year period. Bought 10 years ago. Depends if they count this year or not. Okay, so in the last 10 years, the average appreciation has been 8%, which is pretty amazing, which is 2.5% above the average. So if I were them, I'd want to sell too. You know, I'd want to sell this property too for the profit. 500K though is for an investor. There's no money in it. Yeah, that's. I mean, that's. You're right. You're right. I mean, it's. But these are bleeders, right? These are properties that bleed money. You know, the only reason this property is making money for them is they have a tiny mortgage. But if they were an, you know, if they were a regular, you know, if they came into the property now, and you know, tried to make it work, look at it, 80, you know, 20, like an investment property, you know, 30-year mortgage. This thing is gonna bleed money. Oh, let's go back over here because I made 200. Let's do this. 1,000. Okay, so yeah, this is gonna bleed money, $514 a month. That's with no vacancy maintenance or property management. That's just bare bones, just owning it. This thing will cost you if it's empty, it's gonna cost you $2,000 a month. This thing bleeds money, bleeds money. So I don't believe that. I don't believe it's a good idea to take something like this on. So I don't see the upside of this particular property, Rodrigo. I don't see the advantage of this type of property. And I would imagine the property is, you know, could be sold, but it'd be sold to maybe someone who's going to live there. You know, even that though, I mean, that's tough. That's tough. You have left there. What do you mean left? What do you mean by that, Rodrigo? Oh, you know what? My apologies. The chat moved. Sorry about that. The current tenant is a terminally Terminal cancelled. Oh, that's terrible. The rent is more, however, the current. Oh. What's the rent? What kind of rent you're saying that the rental income? You can get 2,500 for rent. Is that right? So you're saying my client just bought a condo in Mississauga, 2 bedroom, 2 bath for 509. Rental income is. Do you see that? That's basically half, right? Give me 1 second, folks. I'll be right back. Okay. One second. Sorry about that, folks. Just had to step away. Um, so even with the property, now it would be better obviously if it made 2450. 450. Let's look at that. Okay, and it's a condo, right? Okay, so I think it's fair in a condo to say 5% management fee because you're not taking care of the outside. You're paying a condo fee. Maintenance also part of that is condo fee, but the maintenance and management you can reduce in half. I would say is realistic. Maintenance and management combined, right? Because there's property management. So I'd say it's fair to go with these numbers, unless the vacancy number is different, or unless you have different data. So when we come back here and we look at this property, the cap rate's 4.4 with those numbers adjusted. So when we come over here, if we go 80/20, 30-year mortgage at 3%, you are making money, but your return is really, really low on this. So that's pretty much the problem. Is the reason that you're making any cash flow is really because you have enough equity in the property to 20%. Unfortunately, that really hurts your return. So this is my question to you is, would it be better to get some bonds in the stock market producing, a 2% or 1%, 1.5%? I'm not a fan of GICs, this or government bonds, but if you're willing to put up the money, the advantage is, the return on your investment is 2.2. Now, the idea behind real estate, obviously, is it's not just the ROI, right? It's the capital growth of the investment. The dilemma with that You hear me? Sorry about that. Sound is cutting out. Uh, because of that, people, they don't look at the return of 2.2%, because they're looking for the capital growth, right, in the property. So, they're looking at it and saying, well, I get 6%, or 5.5%, or say 6%. So I'm going to make, just do that. So they're looking at, yeah, year one, I don't make anything. Let's go 500,000. That's what it is. But I'm going to make 30,000 in capital growth, right? I'm going to make 30,000 in because the property is going to go up in value 6%, and 6%, 6%, 6%. So, in 10 years, it'll be worth, $844,000. That's the argument, right? That somebody makes about, the property itself. The dilemma or the challenge is obviously is that the property itself, the cost of ownership, makes it challenging to to run a perfect operation where you never, nothing goes wrong. It's always occupied. If you were guaranteed the 2.2, I'd say, okay, well, maybe this can work. But you're not guaranteed the 2.2 return, right? A lot of things have to go right. Good things about the condo uh, investment in year by year appreciation. Yeah, for now, right? I mean, that's the case now. Um, but there's a point, and I want everyone to understand that there's a point where they just become unaffordable, and the only way to fix that problem, and this is what the government just did. The government extended the mortgage, right? The insurable mortgage now is 30 years. Um, that's what's made the change or help the market stay up, is because of that change. Otherwise, eventually the property becomes just unaffordable. If incomes can't sustain them. So again, the prices have to come down if they're exceeding the growth of appreciation, is exceeding the growth of incomes, exceeding the growth of inflation. It becomes a serious, serious problem. Yeah, yeah. At some point, the buyers. I mean, you can't sell houses that nobody wants. You know. And the other thing that commonly or uncommonly gets talked about is these builders keep building these houses, but what are they doing with the old houses? So when people move from one house to another house, the builders can't just keep building houses indefinitely. Uh, you know, the houses, often the house has to be sold before the house can be bought, right? For a lot of people. So that becomes a problem for inventory, especially new houses. And also, if the old house is abandoned, or just, let's not worry about it, it deteriorates. It's not, somebody's not living in it and taking care of it. So it becomes a problem. So the market in Canada definitely got some help with the 30-year mortgage, plus the incentive of the 10% incentive of new home buyers, first-time buyers with new home buyers really with new homes, and if you're buying an existing home, it's not quite 10, I don't believe. All those things are going to help the market, uh, stay afloat. But again, once that's eaten up, it becomes a problem. What do you do next? You go to 35 years? You go to 40 years? They did this in the past, and it's really to create. It's creating creating a market that wasn't there, right? If you got a 35-year mortgage, then all of a sudden, someone can afford to pay more for a house. If it's a 40-year mortgage, they can afford to pay more for a house. What you can't change, the prices can go up and down. What you can't change is how much somebody's making and how much their money goes up per year. I think we went through this example. I know we did with some of you, to show that at the end of the day, you're not really getting more house. You're just paying more for it, but you can afford it because your monthly payment goes down. If we look at here someone can afford $1,700 a year, sorry, a month. That's what their income can allow them to afford per month, based on the mortgage rules. If I bring this down to 25, they can't afford this house anymore. They just can't afford this house. It's this, $18,000, sorry, $500,000 house. Now if we went, the 95 and 5, it still holds, right? It still holds. If someone could afford, so let's do this. Let's say someone could afford, let's go back to 30 years, and you can see it. If you could afford $2,000 a month to pay for the mortgage, that's what you can afford. You'll be pre-approved basically for a $500,000 house. They'll pre-approve you for 500 because that's the mortgage payment. That's a 30-year. But when it was 25, and that's, all of a sudden, you can't afford this house. So what's going to happen if you can't afford this house? What's going to happen to this house? What's going to happen to this house? What happens to this property if the mortgage, if all of a sudden they're 25 years again? Well, if you want to sell it and the market now is 25, this house has to come down. So maybe it comes down to, let's see, 450,000. Too many zeros there. Okay, so now you can afford it, but this had to come down $50,000. So again, it's you can't get trapped with the appreciation. You could take advantage of it for sure. Like these people, Rodrigo, they should sell their property because the return is excellent relative to other properties. I'd sell too. They might hold on another year. It might go up a little bit more. They might catch another good year, but at some point, that property is gonna flatten out and could even go backwards. So I think that to keep in mind, appreciation seems appealing, and it is when you get it, but it can definitely go the other way on you, and at some point it's just not affordable. So, like we said, the government changed this 25 to 30, so the guy can only afford 2,000. Just by changing this to 30, now he can afford a more expensive home. Right now, he can be pre-approved for a $500,000 house versus the 450, right? Because now, his mortgage is $2,000. So the guy's income has not changed at all. His payment has, and that's allowed him to buy more, or at least a more expensive house. Now, where do you go from here? Well, the bank could literally go to 35 years. And look, if it goes up to 35 years, that $500,000 house now can go to 540, maybe. 540, for the sake of simplicity. Yep, so now the house can go up to 540. But what happens when those ones are full? What are you going to do? Well, you can go to 40 year. All of a sudden, no, look, he's got some room now, 570. Now this house can go to 570. Nope, there you go. Now the property's worth 570. Same property. So really there's not a lot to gain from that. At some point it has to be released. So that's why sometimes it's okay to sell a property when the appreciation's been outstanding. So the 30-year mortgage is CMHC. Mortgage brokers now, you can get that done. You can get that now. In fact, one of the students was mentioning, and mentioned to all of us, that he's getting for investment properties. CIBC was offering him 10% down for investment properties, 10% down instead of 20. So the competition is starting to heat up for, looks like again for your business. So yeah, definitely you can go to a mortgage broker right now and get 30 years. Has anybody seen a 35? There might be a 35 out there at Shareable Mortgage. Anybody seen a 35? I know you've seen 30s. Anybody seen 35? Not yet? Okay, you will. You'll see the mortgage brokers coming with 35s. Yeah, it'll happen. It'll happen. It'll happen. They can't keep the market going unless they extend. There's two ways to do it: drop interest rates, and or extend the amortization. This is why in China and Japan they have 100-year mortgages. I mean, because 100-year mortgages basically is an interest-only mortgage. you know. But that's the only way you can sustain the property values in the country. So, you know, that's crazy. That's crazy. So generational mortgages, basically. So, you know, now that's something that remains to be seen in Canada. But Canada has, Japan has been in a, in a deflationary state for over 2 decades at least, if not longer. Um, that's because of their aging population. Because aging people spend less money, so they hoard more cash, and it really creates a problem because they can't get people to spend money, even offering it at 0%. We talked about some of the countries too, offering 0%. We talked about, I believe it's Denmark is offering negative interest rates on their mortgages, which sounds great. You think, well, that's amazing, but it's not. If, no zero interest rate loan means that the market is tapped. It's just tapped. There needs to be an interest rate. There needs to be a cost of it. When you're telling people that the only thing I can do for you is to slow down the loss of your value, the value of your money, slow it down, but I can't actually produce any sort of return. That's a serious problem. When the government like Germany is offering negative yielding bonds they call them, funny, but that's a serious problem for the economy. So no, will Canada go into that state? I don't know when it'll happen. And, it's not beyond the likelihood of it happening. It's just Canada's more closer to the United States as an economy than I would say some of these other European countries, which creates some protection and ability to grow because we have a consumer mentality in Canada too, not quite to the example of the U.S. So my cousin in Germany has 1% interest rate locked in for 20 years. There you go, Devin. There you go, folks. 1% locked in for 20 years. You know, it's and you look at that and you think, well, that's amazing. I would love to have a 1% mortgage, but understand the 1% mortgage is to sustain or try to create some stimulation in the housing prices. You're not going to get more. You're not really saving. Because the house price that you're paying for is more. Now, the good news for this person, a 20-year mortgage at 1%, is interest rates might skyrocket. Interest rates might be 15, in 10 years in Germany, and he's only paying 1%. That's a big deal. That's a huge deal. So, you gotta take what's there, obviously, but at the end of the day, this is why, again, folks, the numbers themselves, the value of the property, the income, the expense, it only matters, the interest rate for the mortgage only matters in reference to us running the numbers on our property and ensuring that at the end of the day, does this make money? Does it make money now? Looking at this one, Rodrigo, that we're talking about, it doesn't look like there's a lot of opportunity here on this property. It just doesn't produce enough here. Now, I'm sure that most of you were on that call or seen that call where we went through and we looked at the map of Canada. You could do in the U.S. obviously same thing, and we saw that the rents relative to the average price was about 0.5%. So the market itself is mostly a retail market, but there's definitely a lot of pressure in the country, both the U.S. and Canada. This is why the economy is so important that both countries are producing, are growing. Their GDP is growing. Their growth is growing. So I think the U.S. announced, they said that today, I think it was today or yesterday, I think it was today, 2% growth is the expectation for the country. So that would seem ridiculous, 10 years ago. Well, 10 years ago, that's after the crash. So I say 15 years ago, the growth was much larger then. So because these things happen in the economy and we have no control over them, really we don't. This is why it's so important to make sure that everything that you add to your portfolio for all intents purposes makes you money. So regardless if your interest rate is 1%, 3%, 5%, that's all going to be factored into the price. It's all going to be factored into the price. So you definitely want to run the numbers, do your due diligence to make sure the property makes money. So Rodrigo, do you have any questions about this? Is there anything else you want us to try or do with this? There's not much we can do, Rodrigo. Sorry about that. There's not much we can do in the way of price. I'm sorry, the metrics except maybe price. If you could reduce the price, that would definitely help your cause. But you'd need a considerable reduction. We need this cap rate to move up from 3.9 to about a 6. So let's see what that would look like. Let's see. About 370, I think, get you there. 370 should get you there. Yep, 370. Now this property was 370, and we're getting this rent. We could definitely make some money on this property. You can see right there, right? That's with the, but even if we did the 80/20, and we did 30-year mortgage, 30-year mortgage, yeah, you could do this. I mean, but look at the price that would have to be, 370. And the reason that the 6, we're getting so much out of the 6 is because the expenses, because the maintenance and management are reduced because of the condo fees. Now, that being said, I'd have to put in the condo fees here. So actually, okay, and we're going to make that, it was 672, I'd say 7,500 to be realistic. 625, that's about right. So cap rate drops to 4. Then it doesn't make any money. So actually, with the condo fees, we'd have to maybe reduce this price even more. However, we were okay with. So not really. We definitely knew this was not a good deal for investing. Yeah. However, we are trying to get into a situation in which we challenge ourselves to find an answer in how to help a property that produces negative numbers. Yeah, absolutely. That's excellent. I love that. So really it comes down to, these are the components that we can change in a property. So let's go back to, let's do something like so it's 25. So let's go 300,000. Let's go standard and we'll walk through that. So $300,000 property. Let's go with the standard 5 and 10 there. The expenses are there. Let's see, they're 4.2 because we added the 75. So take that out. 0. There we go. Now we're back. Okay, so $300,000 property. There's a little bit of repairs. It's going to produce. Say we can get $2,000 for it. Okay, so here it is. This is a property that's $300,000, rents $2,000 a month, which is pretty good when you consider most of them are closer to $1,500, $1,600. We put in the expenses that are in there, the actual expenses that associated with this property. So we have taxes, which wouldn't be far off of that in a $300,000 property. Insurance, and insurance would probably, insurance is all right. I mean, it would probably be, no, insurance, that's tenant insurance. That's more like 1,200. It's more realistic. Gas, 646. Let's just assume the tenants are paying everything, okay? So you pay nothing, tenants are paying everything, okay? So now we have a 5.1. 5.1 looks like it produces $300 almost, 280. Problem is it's 5.6% is the return. So here we have a problem, right? Property looks good. A $300,000 property producing if you want, we can go with the 1,500. That's probably what you're going to see is this kind of relationship. Expenses are what they are. 3.5. This is pretty much standard what you're going to see in the market. 3.5 cap rate. 80/20, right? We have the 30-year mortgage at 3%, and we see that the property loses yearly cash flow is negative $1,400. Monthly cash flow is 117. So this property for an average person is a break-even property, right? They might even argue if we take away this, they just don't count vacancy and maintenance and management. They don't count it. Um, you know, they're going to look like, well, I make $182. I mean, this is a great property or a good property. 3.6%. Who cares? They're not looking at that. They're looking at the cash flow, and they're also saying the tenant's paying the mortgage down, plus they have a capital appreciation. This is a great deal. That's what they're thinking. The dilemma is these expenses are real, and we know they're real. When you own a property, you learn real quick they're real. So what do you do with this, Rodrigo? What can you do with this, and everybody else? What can we do to improve this? Well, there's a couple areas that we can improve it with. So first one is price, right? Obviously, and I want you to focus on the cap rate, really, because that's going to make the difference, right? So let me just do this real quick so we can see it. So if I can get this down to say 250, okay, this property cap rate goes to 4.2. I'm looking at $50. It still doesn't work, right? 200,000, right? But now think about this. I'm asking 200,000, closer, almost there, but not quite there because the return kind of sucks at 6.6. But you can see the cap rate's increasing every time I move it. Now think about this. If the property was originally offered at $300,000 again, there's it's going to be hard for you to get a drop from 300 to 200. It's just not going to happen. So cap rate, Devin, is the return I would get if I paid cash. So if I paid $200,000 cash after my expenses, I'd make 5.2% return on my money. Okay, so that's if cap rate represents what I would make if I paid cash. Okay, 200,000, which obviously we don't want to do, right? So we need, and you can see the return is only slightly higher with the financing. So remember, this is an investment property. Target's 10, but if you can get a 6, we can make it work. So let's go back to the real world. Let's say that I can get it for, say, let's see if we went 10 would be 25. Let's say 270. Okay, so we get 270. We come down here, Rodrigo, and we can see cap rate's 3.9. This is still not going to work. So price is one area that we can help ourselves. The next area we can help ourselves is expenses, right? So if somehow we can reduce these expenses, that would be big, right? Now this is pretty lean when you think about it. I mean, all we're paying is insurance and taxes. They're paying all the bills. So let's say that we're in a market where it's only 5% for management. And this is why a lot of people manage their own properties. Let's just put it at 0, and you say, Rodrigo says, I'm going to manage this myself. You can see your cap rates pop to 4.5%. You're positively cash flowing, and your return is at 3% now, where before it was not. I'll just give you an example. I'll give you a look back. We popped that back to 10. This was losing, $20 a month, and it was negative return. So you might say to yourself, well, I'll manage this one first because it's close by and I'm just going to do it. So that helps, but it still doesn't get you to your targets, right? So we reduced the price. We said we'd manage the property. The only other option really now becomes the financing, right? Now the other one is you can raise the rents. Obviously you can raise the rents. Let's do that. Say we could get $1,650. We could raise the rents. That's going to make a difference. You see that it goes up to 5.1%. So this gets us closer. We're at 6, and now we're 268 on the property. Now the other area, and this is we're not bringing in somebody at this point into the property, but the other area is I could maybe get a 40-year mortgage. Now if I get a 40-year mortgage, what happens? My payment goes down, and boom, lo and behold, now I'm at 9% at 4.5. Now did you see all the things we had to do, right? I had to extend my mortgage. I had to reduce the price. I had to, increase the rent. I had to reduce the expenses and manage it myself. All these things combined will get you closer to your target. That's what it takes to take these properties that are not really producing any money at all It's usually a combination of a few things and not just one thing. The other area we'll say obviously is you know, if I'm at 30, instead of 30, maybe I get a 35, right? I can only get a 35. That doesn't quite get me there, but I can get it for 2.5. All of a sudden, boom, I'm over here again. You see, I'm closer. So it's a combination of things that really gets you there. And it's not just price. In fact, I would rather you got close to the purchase price. You know, I want a little bit of buffer, make money in the buy, obviously, but you know, that's relative to a distressed seller, right? And a distressed property. And I'd rather you work with better properties than worse properties, unless you're in the area of rehabbing. Um, but that's why there's such huge opportunity in rehabs and properties like rehabs, uh, because they're the value, you know, the discount that you get is much larger than a retail property. So you know, it's typically a combination of things that'll get you there. That being said, Rodrigo, the property we were looking at, you know, the $500,000 property, would be virtually, I don't want to say impossible, but pretty close it's impossible to get where you want it to go. Okay, because, and just to give you a quick example of that, if the property, you know, going back to 500,000, just as an example, you said you could get it for what, Rodrigo? What do you say you could get it for? Maybe four. What is it? 470. Okay, so 470, which is not a huge discount. I mean, it's, you know, 470 is fair. Rent is 1,500, but let's say we could get the 2,450. Okay, but we got to go back over here. We just got to make a couple adjustments. You know, we'll make this 5, this a 2.5, and we'll add 7 for condo fees. I think we said 7,500. We'll get us close to that 650. Okay, so this is kind of what we're working with this one, Rodrigo. So you can see that the cap rate, and let's go back to 30 year. So standard stuff, 3 year, 3%. Okay, so this now looks right. Okay, so cap rate's around 3%. Okay, so we see that the property is already starting at the negative. You know, what would we have to do to get this property to where it needs to go? Well, we've reduced the price already, but the discount, I would assume it needs to be closer to 10%. So 450. You know, that's going to help. Okay, that's more realistic, possible for us to get considering the market's sitting around 470, right? You know, reduce expenses, 0 for property management. Let's manage it ourselves. Okay. Let's go. Now it's 3.5, but it's still not there. Let's see if we can get a 40-year mortgage at 2.5%. I wouldn't doubt. I doubt we could do that, but let's go 3%. It's more realistic. Well, now you're making $50 a month, and it's 6%, 0.6% return. You can see that there's all sorts of problems here, Rodrigo, because you're starting with something that's so far. I mean, this was originally 1,500, right? I mean, forget about it. This thing's gonna bleed money. $830 a month. That's with us reducing the price. That's with us, you know, getting a 40-year mortgage at 3%. That's with us managing it ourselves. You see that, you know, this one's got, it's too far to go to make this property work. So at sometimes, and sometimes you just have to say to the realtor, you know, the seller, if it's a seller, you say, you know, I really appreciate you spending the time to give me this information. Unfortunately, it doesn't work with our current model. Do appreciate that you send us over that information. Just want to let you know if something does change, let us know. But at this point, we can't move forward based on the numbers that we have. Thank you very much for your time. That's a response to a seller. To a realtor, you would say thank you very much for the time you spent sending me that information over. I ran the numbers. Unfortunately, at this time, it doesn't work for us. But just to let you know, we are serious about getting involved in some, you know, we're new investors in the area, serious about getting involved in more property. So please, to let you know, these are the kind of properties that we're looking for. And you tell them, I'm looking for a property that has, you know, a 6 cap rate or as a minimum, you know, 6-7% cap rate. I'm looking for properties that are duplexes. I'm looking for properties that are, you know, fourplexes. Tell them what you're looking for. And let the realtor send you those listings instead of doing an open-ended listing where they're sending you everything that they have or ever seen. just be honest and specific. I can't work with properties that are less than a 6% cap rate. You know, this is kind of what you want to do when you're dealing with people, because there's no point in trying to come back to that seller, as an example, Rodrigo, and saying to them, "Oh, I need you to sell the property for 300,000." There's no point in doing that. That's not going to happen. The market won't let you do that. So, you know, at some point when you run these numbers, you know right away. So you just send them back an email real quick or a phone call and you say thanks for your time, and give them back the information. That's really the best thing to do. So some will, some won't. Move on. Run the numbers, move on. Run the numbers, move on. Run the numbers, move on. That's really what this is about. Don't get too attached to any one individual property and just keep looking over and over again. But I really applaud your desire to try to fix a property that's not so good and make it better. That's the whole game. That's the whole game. That's exactly what we want to do. So I would never say no to anything until we run the numbers. But this one particular, Rodrigo, I think it'd be extremely challenging for profitability. Uh, it's had a great run. I can see why they want to sell for sure. I would sell if I were them. That's like great. I mean, 10 years to double. They're about 2 years ahead of schedule. Two to 5 years ahead of schedule, right? Usually it's around 12 to 15 years for a property to double. Them doubling in 10, they're about the average. It wouldn't be a bad idea to get rid of it. So I can understand the advantages for them. That would be a nice chunk of change for them to grab. Now, who knows what they paid in between? We know they paid 200,000, but we don't know what they paid in between. Who knows, right? What it cost them? But they've had that long-term tenant at $1,500. Now think about this: $1,500 at a $200,000 property. That's outstanding. But 1,500 for a $500,000 property, that's unsustainable. That's unsustainable. Okay. Okay. Any questions about this before I close it out? Anyone? No, we're good. Oh, my pleasure. My pleasure. No worries, my pleasure. So everybody, just a reminder again, we're wrapping up the meeting for tonight. We will not be running any meetings in December. We will be back January 8th. January 8th will be our first meeting in the new year. It's the second weekend, second Wednesday, sorry, second Wednesday in the new year. Agreed. Yeah. Happy holidays. Happy New Year. I want everyone to have a great holidays. I hope, and you know, spend the time with the family if you can. Do a little bit of work this holidays. Don't do all work, but do a little work. Keep looking at properties. Keep doing it. You can reach out to me and ask me anything. Um, I want to wish you all a great finish to this year and an awesome new year, and maybe set some goals for yourself for the new year on some properties. One or two properties really is really what I'd love you to set. That's all it is. Just get one property. I just had a student, actually, one of my students from Vienna, get their first property in the UK. It was awesome. Very excited for them. So I mean, it's happening all over the world. There's opportunity everywhere. So keep pushing yourself. Thanks, Rodrigo, for sending us that deal. It was a great opportunity to talk about how to make something better. Um, um, and I'm sure if you keep doing what you're doing, Rodrigo, you guys will find one sooner or later. Hopefully sooner, of course. All right, folks. If you're good, type in yes or Y. Cool beans, cool beans. This video will be up in the next day or two. I'll try to get it downloaded tonight and uploaded for tomorrow. Otherwise, I want again wish you a happy holidays, and I'll see you all. January 8th will be the first Wednesday we'll be doing it in the new year. Happy New Year, folks. Happy holidays.